Hello, and welcome to another webcast in our Energy Webcast series. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Oil and Gas Tax Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn it over to Pat Hanley, Partner and Energy Group Tax Leader here at Moss Adams. Pat?
Thanks, Amy, and thanks everyone for attending today. We would have preferred to have this in person, but with technology, we're very grateful to have this webinar today. Also with me is Duane Snyder, who is a tax partner in our Dallas office, who is the firm's Central Region Tax Leader. And I have Marty Tschida, who is a tax principal in the firm's state and local tax group here in Denver. All 3 of us have extensive experience in the oil and gas industry, and that's pretty much our main focus. And today we'll be talking about some legislative updates that you've seen over the last year, 2 years, some things to be looking out for as we move into 2021, and some hot topics in the industry. I will now hand it over to Duane. Thank you.
Thanks, Pat. And I will apologize up front. I am getting over a bout with the coronavirus, and I have a lingering cough, so hopefully I can keep it under control. But the first thing we wanted to talk about is just the CARES Act and some election implications. The CARES Act is also the Coronavirus Aid, Relief, and Economic Security Act. And some of the big benefits that it generated, and it was passed earlier this year, but one of the big ones is it allowed NOL carrybacks for 5 years versus going forward as a carry forward. And the big benefit with a 5-year carryback is that it actually allows us to get back into years where potentially companies were paying 35% tax rate. The current corporate tax rate is 21%, so that allows some, more value to be derived from those carrybacks. The other thing that it did is A&T credits were refundable over a period of time beginning in 2018, and the CARES Act allowed that to be accelerated there was a national election. So normally in 2018, you would have received 50% of your AMT credits refundable. And what the CARES Act allowed is an election to be made to go ahead and get all of it once you filed your 2018 return. Alternatively, it sped it up and allowed you to get half of it in 18 and half in 19. And some of the issues, we're dealing with some of those carrybacks now. It also, we had a repeal of the AMT credit. And so just when you're doing those NOL carrybacks, the IRS issued some guidance late this summer on how you utilize basically your AMT NOL. And in essence, basically they're saying because AMT is not around for corporations in 2019, that you don't have an AMT NOL to carry back. So it does change some of the flow as far as when you're getting your refunds. But ultimately, since the AMT credit is refundable, you should be ending up getting the value that you were anticipating. The other thing is we had some interest limitations under 163J, and normally that was 30% of AGI basically limited to. And there were some questions whether or not any depletion, deduction, and amortization could be added back to determine your AGI. And they did amend the interest limitation to allow more interest deduction for taxable years that began in 2019 or 2020. And it also allowed taxpayers to use the 2019 adjusted taxable income to determine the 2020 limitation. The other thing it did is it repealed the limitation that begins before January 1st of 2021 for excess business losses for individuals, and it provided a payroll tax deferral as an opportunity to basically shore up some cash and provide some cash savings for companies, in addition to expanding some employee retention credits. So, and I do have to say that even as of this morning, there was more commentary released on this. The Paycheck Protection Program basically offered a potential, loan that has the potential to be forgiven. The IRS has issued several different documents that basically double down and say that that deductions or expenses that a taxpayer has paid associated with PPP loans are not deductible. And the IRS thinking is that you're not taking it into income, so you shouldn't get a deduction for those expenses. This morning, again, there was a release, and they are trying to get basically allow these deductions be deducted, these expenses to be deducted. And so, some people seem to be pretty optimistic whether that'll get to go forward or not. These other guidances that have been issued by their IRS basically lay out the scenarios of what you do for expenses in 19 that you incur for loans you expect to be forgiven, and things like that. So this could change pretty quickly. So we'll talk about just some, election implications, what, under Biden and Trump, what the differences on their tax plans could be. Also wanted to point out that there's 35 tax extenders set to expire. Nearly every year for the last decade, we've had a collection of tax provisions for business and individuals that have routinely expired and then been temporarily reinstated. And so that's how they get these tax extenders nickname. Generally, they fall under 4 different categories such as cost recovery deductions, energy, incentives, individual and other business provisions. And And Amy, with that, I think we've reached our first polling question.
All right, thank you. So our first polling question is, which of the following do you spend a majority of your time in practice? A, partnerships, B, S corporations, C, corporations, or D, individuals? And I will give you a few minutes to respond here. To participate, please click the button next to the answer you choose and hit submit. And we will wait a moment. It looks like we have quite a few people responding so far. All right, here are the results.
Great. It's a pretty good mix. Majority it looks like partnerships, but then corporations, and then individuals and S corps being very close. Okay, with that, we have a number of slides in here to discuss the difference between the current law and Trump's plans and Biden's, what's anticipated if Biden is to be successful in this area. We do realize that there's still some unknown on the election results. But we're just presenting the two as based on Trump's plans versus Biden's. And I'm not going to go over every single one of these slides, but I'll highlight some of the relevant items as we go through. So the first one is just the corporate rate. As I mentioned earlier, the corporate rate used to be 35% on the high end. That is now 21%. Under Biden, I think the anticipation is he would raise it to 28%. So not all the way up to the full amount it used to be, but definitely more than the 21% we have right now. And for companies that were reporting more than $100 million of annual income, book income, he would enact a 15% minimum tax on book profits, reduced by any foreign taxes paid or loss carry forwards allowed. QBI deduction. So right now we get a 20% reduction for taxpayers other than C corporations on QBI, and I think Biden would phase that out for taxpayers earning more than $100,000. And right now we get 100% bonus depreciation for eligible property through 2022, and it phase out starting in 2023. This is one of those tax extenders. Right now there's no specific plan announced under Biden, but he generally supports reversing the provisions that benefit corporations in this area. So Biden would anticipate creating a few new tax credits and expanding what we call the work opportunity tax credit for eligible taxpayers. And then one of the big things here is right now, currently for fossil fuels and renewable energy, we have a lot of incentives, especially for fossil fuels in the form of a deduction for our intangible drilling costs, and then deductions for lease and well equipment through bonus depreciation, and then depletion through leasehold costs, but also for the potential of a permanent deduction under depletion to the extent we're qualifying for percentage depletion and excessive basis. Biden is anticipated to want to end the fossil fuel subsidies that I just alluded to, and then reinstate or expand various tax credits designed to reduce carbon emissions. And so we'll see what happens in this area, but that's kind of the thought right now. And under President Obama, I think there's a lot of thought that he really tried to change the impact on coal producers, and so I don't think people expected that fossil fuels to be Biden's equivalent of the coal industry, but those are the issues being discussed. On international, so we have guilty provisions, guilty taxes that are forced upon or on different companies, and what Biden would do is basically double the cut rate of those and then eliminate a guilty exemption that is currently in place. On the individuals, right now the top rate is 37%, expected expiring after 2025. What Biden would anticipate doing is raising the top marginal rate to 39.6% for income over $400,000. Also for individuals making over $1 million, he would propose to tax capital gains at ordinary rates for those individuals. And then there is further discussion on limitations on the benefit of standard deductions and itemized deductions. Excuse me. One of the issues is there's been a cap on the deduction for state and local taxes. Biden generally supports eliminating that cap, so that is one benefit. You know, Biden has some plans for student loans and child tax credits. And then there are potential payroll tax savings that he has proposed as well. And with that, I believe we're coming into our second polling question.
All right, thank you. So the second question is, how likely do you think Biden's anticipated tax policies will get implemented by December 31st, 2021? A, 0%, B, 25%, C, 50 to 75%, or D, 100%. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Give it another moment here. Okay, here are the results.
All right, 25% seems to be the winning number there. So we still have about a third that are thinking it's 50 to 75%. All right, and with that, I'm going to turn it over to Pat to talk about partnership issues and reporting.
Thanks, Duane. I'm going to touch on some hot topics with partnerships and some things to look out for, especially with K-1s in 2020. But the IRS has stated numerous times over the last year to 2 years that they're going to be auditing partnerships a lot more than they have historically. This is an area that certainly a challenge for the IRS because the tax is ultimately paid at the partner level. And so with that, to make it easier, they've made some changes to the K-1s to provide more transparency. We saw some of these on the 19 K-1s, and then some will be on the 2020 K-1s. We'll go through some of the more important ones. I guess disregarded entities, also single-member LLCs. More and more partners are using single-member LLCs to hold their interest. And since they're disregarded, the IRS wants more transparency around who the ultimate owner is and who the ultimate taxpayer is. Also with transfers of interest, which can trigger a lot of gain, they want beginning and ending ownership percentages. A little more detail around that so they can track any gains at the partner level as a result of movement among the interests. Liabilities, very important on K-1s because liabilities allocated from partnerships give the partners basis to be allocated losses and basis to take distributions. And in multi-tiered partnerships, liabilities flow up, and it's hard for the IRS to track, exactly where the liabilities are coming from. So more disclosure on separate liabilities flowing up from lower tier partnerships. 704C reporting, definitely more disclosure on that, and this is built-in gain associated with any property being contributed or any revaluation of 704B capital accounts, also known as book-ups, which is reverse 704C, but essentially when these transactions happen, partners have built-in gain, unrecognized built-in gains and losses known as 704C, so those are being disclosed on the K-1s. When you go to the partners, there's several limitations to actually take losses, first of which is being just total basis. Then you look to at-risk basis, and then you look to see if the partner is active or passive. And if they're passive, losses may be suspended, also known as passive, passive activity losses. And so detail in the K-1s around how many activities flowing out are passive activities and at-risk activities. Something new in 2020 to give the IRS a little more handle on international tax reporting is Schedule K2 and Schedule K3, which are 20-page forms. So definitely voluminous in volume and will require a lot more work to the extent the partnership has any international activity. The big item in 2020 that we'll be encountering in the 2021 season is the IRS mandating that all beginning of year tax capital accounts be disclosed on the K-1s. On the 19 returns, it was required for the first time that if a partner had negative tax capital, that it was required to be disclosed to the extent that the capital accounts are being maintained on a GAAP or 704B on the K-1s. So to the extent it was negative, you had to report, otherwise nothing. But in 2020, all K-1s have to show beginning of year tax capital regardless of positive or negative. A notice came out in August, a few months ago, 2020-43, that outlines some kind of proposed rules around coming up with this method, and they're basically allowing taxpayers to use 4 different methods for this determination. First of which is the modified outside basis method. I think, in my opinion, especially with oil and gas, this is the most, I think, troublesome from a practical standpoint, because you have to go out and look at each partner's outside basis. And in oil and gas, you've got IDCs and depletion and several things that could make the outside basis different. And so coming up with outside basis per partner, less allocated liabilities, may be a challenge. Second is modified previously taxed capital method, which is a hypothetical liquidation approach that says if the partnership were to sell all of its assets at fair value, settle all the liabilities, how would the cash get distributed? Less any deemed gain on this sale, or plus any deemed loss on the sale, would give you this tax capital. This could propose some challenges as well, to the extent that fair value isn't readily available, and you really have to get a handle on the operating agreement to make sure that these hypothetical liquidation allocations are in accordance with all the hurdles, et cetera, in the agreement. Third method, 704B, which is essentially taking all of the 704B capital accounts, which are the kind of the economic capital accounts, plus or minus any 704C gains and losses. The fourth method, which I think is what everyone's most familiar with, it's the tax basis method, also known as the transactional approach. And this is really, I think, what everyone's used to. It's using the standard provisions under 705, 722, 733, and 742. But essentially, increasing the capital account by any cash contributed, property contributed, items of gains and income items, minus any distributions of cash and property. Any of these methods that I mentioned can be used to determine beginning of year capital, but for each year thereafter, you're required to use the transactional method. Our firm's a big proponent of maintaining tax capital on day one. Seen numerous times where tax capital gets ignored since it's not being required to be disclosed historically on the K-1s. And you get 5-6 years into a deal, and the partnership, calls you up and they want to liquidate, or there's a significant sale or a distribution, and you got to go back to day one and roll tax capital. And meanwhile, there's been transfers, new partners admitted, and it's an extra project that you don't want to get yourself into. We've also, picked up new clients from other firms where you get all the work papers and think everything's great, and then when you kind of fast forward, realize that tax capital has not been maintained, and not having the history with all the activity is very difficult. So kind of the takeaway is, always maintain tax capital day one and roll it from year to year. It's now required, but while you're at it, since you're gathering all that data, with assets and liabilities, also kind of a fan of maintaining a tax basis balance sheet. So always having, that data available in the event that the partnership wants to do any significant transactions. Because at the end of the day, tax capital for every partner has to go to zero, upon liquidation or wind up. If in total it's zero, but certain partners have positive capital and certain partners have negative capital, there's an error. And so making sure that, you're kind of tackling this on a year-by-year basis prevents, any last-minute surprises at the end. The IRS has provided a notice that says, they will potentially grant penalty relief to the extent that there are any, discrepancies or errors that they discover upon audit in this beginning capital account. But they'll only grant this release if the taxpayers were prudent. They took a reasonable approach. They gathered all the documentation. The documentation is in the files. And if all this kind of adds up, and they won't assess any penalties. There also may be some reasonable cause exceptions to any penalties, but I think more to come on that. Amy, we're at our next polling question.
All right, thank you. So our third polling question is, once beginning tax capital accounts as of January 1, 2020 are determined, which method is required for reporting tax capital accounts for each year thereafter? And you have your options below. Select the one you choose and hit submit. And also, for those of you that would like a copy of today's slides, you can download them now from the folder that says slide deck and handouts, and we will also be sending them out tomorrow via email. And while people are responding, I will also remind you that if you have any questions throughout the presentation, go ahead and submit those in the Q&A widget that's in your console. Okay, here are the results.
All right. Well, it looks like most of the people got it right. So the answer is D. I think, like I said, I think that's the most common method and what we're used to. All right, moving on. Just a couple of things to note with Section 163J and 199A. Duane mentioned, some additional benefits, I guess, as part of the CARES Act for the short term. But 163J, an interest limitation, is sometimes difficult to report through partnerships because there's so many separately stated items that could impact the adjusted taxable income number that's driving the limitation. And so when you've got multi-tiered partnerships, the lower tier partnership, which is typically the operating partnership, is going to do the limitation at that level and then hand out all of the detail on the K-1s for the partners to determine at their level what the interest limitation may be based on adjusted taxable income, et cetera. But once that goes up one level, it stops there. It doesn't go up to another level. And, we've got clients with multiple tiers. So one thing to watch out for is, since it stops at that first level, that partner is going to reduce their capital account but not reduce their outside basis. And so this could create some character of income issues down the road if the partner's not there for the whole time period where the interest, is freed up and deducted at some point. Because at that point, that additional outside basis is an attribute that represents a future, interest expense. But if that partner decides to sell their interest, or something happens with that with that partner's interest by not getting the deduction, that otherwise ordinary interest expense gets converted to a capital loss or a reduction in capital gain. So there could be a character whipsaw there to watch out for, as it flows up. But again, the main thing I wanted to point out as well is it does stop at one level where, I think some folks out there are just continue to flow all that data up through multiple tiers. 199A, which Duane mentioned earlier, the QBI deduction at the individual partner level, it is a 20% deduction, and it was the IRS's attempt to give partnerships a tax, rate reduction, kind of similar to what it did with corporations, but it didn't quite get there, and obviously made it much more complicated than just a simple rate reduction. So, especially with oil and gas, when you've got, definitely things at the partner level that could impact this deduction by, electing to capitalize IDC to increase the QBI. The partnership could elect out a bonus depreciation, et cetera. So, definitely the 199A deduction at the partner level could look a lot different than what the partnership thinks it's going to be. The other thing is the deduction itself is not a reduction in basis. It's just a kind of a permanent deduction at the partner level. A couple of questions that we've been asked over the last year, in this pandemic or the market that we're in is, hey, in order to take an ordinary deduction, can I just deem my partnership interest worthless? I mean, you can, but you've got to look out for a few different things. One is the worthless loss must be claimed in the year the property partnership interest becomes worthless. You can't just pick and choose when it's worthless. It has to be at the point in time that all the documents support, worthlessness. The other thing that the IRS could challenge is if the partnership has non-recourse liabilities, they can always contend that, the value of the interest is at least equal to the partner's share of the non-recourse debt. Also, if there's recourse debt, the IRS could contend the open transaction doctrine applies until the debt is satisfied. So definitely some things you need to look at. Along those lines, we've been asked the question, and not just in the last year, but over the course of time where, maybe the partnership is not doing very well, the oil and gas, the prices are low, and they say, hey, I want to abandon my loss or abandon my partnership interest, take an ordinary loss. And this may be a little more common coming up depending on what tax rates look like in the future, for tax planning purposes. And so to take an abandonment loss under Section 165, you've got to make sure you've got some good documentation in the file. One is the partner has to have an overt intent to abandon the partnership interest. And there needs to be an affirmative act of abandonment, which generally requires a formal notice to the partnership. The biggest trap that we've seen is in order to get an ordinary loss on abandonment, there cannot be a sale or exchange of the interest. And if there's any liabilities still being allocated to that partner, this will trigger a sale or exchange because those liabilities, when they go to zero upon abandonment, it's a deemed distribution under 752B, and that distribution falls under the liquidation rules of 731A, which leads to a sale or exchange, which converts an ordinary loss to a capital loss. The next thing to point out is even a de minimis amount does not give you an exception. So even $1 of debt being allocated will kind of trigger a sale or exchange and get a surprise at the end. I will hand it back to Duane.
Thanks, Pat. So one of the things, especially, we talked about the difference in the tax rates that potentially could happen. And there's a lot of considerations on what could happen with transactions. Historically, there's been a lot of analysis done when you enter into a transaction, whether or not you want to sell the stock or to sell the underlying assets. And generally, excuse me, in the past, the stock has resulted in a capital gain that has gotten a much more beneficial tax rate. So what would happen is a selling shareholder would want to sell the stock, but a buyer would often, if they buy the stock, they don't necessarily get a step up in the underlying asset basis, and so they don't get any depletion or depreciation or cost recovery deductions associated with the value of what they really paid for the company. And so there's a lot of negotiations and trade-offs and back and forth on which is better for everybody. Do you get to step up in basis and not get the capital gain tax rate benefit, or do you go ahead and do sell the assets? The seller ends up paying more tax, but then the buyer can get more benefit down the road. With the things being talked about, excuse me, right now, we have a taxpayer that's expected to be in the higher income. There is the potential that they would not get a capital rate benefit. And so that may be one of the considerations that actually may make it easier to get a step up in basis in the transaction. And another consideration is just that what we call a 1060 allocation, where we're providing it. We have a transaction, and what is the buyer and the seller? What are they allocating to the underlying assets? And so, by allocating more value to leasehold costs, generally that's recovered through depletion, and that depletion can go out for 50 years. It depends on the reserves and how quickly those reserves are being recovered, depleted, so forth. Whereas tangibles, so lease and well equipment, with bonus depreciation right now, a lot of times we can get an upfront deduction for that. So there is there's an incentive for a buyer to want to allocate more to the intangibles, or the tangibles, lease and well equipment that they can recover currently versus the leasehold costs. In addition, currently right now there is the percentage depletion in excess of basis. So even once a company fully recovers their leasehold costs through depletion, there is the potential that they get a permanent deduction to percentage depletion going forward. Taxable versus non-taxable transactions. So generally, a lot of ways that there are for the seller to go ahead and continue on with the new entity in some form of an investment structure that could cause the current transaction, either all or some of it, to be non-taxable, versus if they want to completely cash out or come up with something that gives them a little more liquidity in the taxable transaction. So those are things that are always being considered. Also, how much debt and equity do you really want to put into transactions when you do have a transaction? With the current interest limitation deductions, it may not be as straightforward as it has been in the past. We'll also talk about 382 here in a minute and some of the implications there. As part of transactions, we always want to look at it whether or not you have a significant modification to the debt instrument. If you do, there's a potential that we could have a gain or loss on the deemed exchange, and there's always the potential for cancellation of debt income. And then we could have original issue discount rules. And so some of the things you want to look at is if you're redoing the debt, is it considered significant modification? And so the most common are change in yield or interest rate or change in timing of the payments. Some of the things, we are seeing some further consolidation within the industry. And along those lines, going back to 382, so on 382, what that was put in place, so decades and decades ago, you used to be able to go out and buy a company that all it had was an NOL. and you could buy that company for some value and then have an investment, have it invest in operating assets that you would use that old NOL to shield some of that income. The IRS put in a number of different limitations to help mitigate that, but one of them is 382. If you have a greater than 50% ownership change over a 3-year period in a company, then that triggers one of the 382 limitations. And so what would happen is your NOL or any other tax attributes are limited based on the value of the company at that time. And so under current interest rates, with such a low rate, that is one of the things they look at in determining what the annual limitation is. The October last month 382 rate was less than 1%. So if you paid, for example, $10 million for a company, the actual interest rate limitation is 0.85%. What that means is if you multiply that times the value of the company, you're limited to an $85,000 deduction on your NOLs or other tax attributes going forward. And so it can really string out the ability to use some of these NOLs. In addition, NOLs prior to 2017 had a 20-year life, and so those could actually end up expiring unused with that limitation. And all these issues have state and local tax consequences. So Marty will talk about some of those here in a minute, but just wanted to highlight that those are some considerations. Also, just to point out that on transaction costs, you can generally, successfully transaction costs do have a safe harbor that you can look at that would allow 75% of those fees to be deductible. The remaining 30% are non-deductible. And so there's a safe harbor. It doesn't mean that you have to follow the safe harbor, but it's one of the things to consider. So I talked briefly about 382. So one of the things when you think about if a company is producing audited annual reports, the value of those tax attributes, those NOLs, could get significantly reduced because of the 382 limitation. And so that's something to keep in mind. In addition, a lot of times what would happen is, especially with an oil and gas company or even other companies, you can, if you're not getting a step up in those underlying assets, you do have some value there, and that's really what they consider as a net unrealized built-in gain. That you can have a situation where you have a net unrealized built-in loss as well, but basically those new bigs and new bills can impact that 382 limitation. And one of the ways that you could increase that 382 limitation was to look at your realized built-in gain that was recognized over the first 5 years after a transaction. And notice 2003-65 laid out a couple of different approaches to do that. There are proposed regs that would eliminate one of those approaches, which is basically the 338 approach. And then, in this environment, you always have bankruptcy considerations. So there are some specific rules under 382 that could help under a bankruptcy situation. So even though you could, under bankruptcy, have a greater than 50% change in ownership, if you meet these thresholds, it may not cause a 382 event that would limit your NOLs. There are issues associated with that could, play out with the subsequent 382 limitation, but it's something you could consider. Cancellation of debted income. Unlike corporations, which are generally able to exclude cancellation of debt income from their taxable income, partnerships CODI basically passes through to the partners, often resulting in partner cash liabilities. So that's just something to keep in mind as well. And I believe, Pat, I'm turning it back over to you to talk about the ASC 740.
All right, thanks, Duane. I know, based on that first polling question, that there's a lot of partnership and corporate people in the audience, so I won't spend too much time on, income tax provisions, and this is certainly not a provision course, but just want to highlight a few things under ASC 740 in this environment that we're in. Valuation analysis is always a hot topic when the company's in a deferred tax asset position. Right now, when you look at whether or not to have a VA, there's some additional factors, I think, to consider in this low pricing environment that we're in, as well as just all the uncertainty around COVID and the election results. Not knowing what the tax rates will look like in the future, the regulations, not just at the Fed level, but the state and local jurisdictions that may impact the industry. So, historically, the heaviest weight of evidence is looking at 3-year cumulative book income or loss. If you're in a 3-year cumulative loss position, the general rule would be you should have a valuation allowance unless there's other factors to kind of outweigh that. But, in today's environment, the history may not be very indicative of what's going to happen in the future. You could be in a 3-year income position because you've got really good, hedges in place, but those hedges could be rolling off, in the next year or two that could, significantly impact the operations or the P&L of the company. So when you're looking out in the future, projections are going to be a little bit heavier evidence, but when you are having projections, that future income really must be objectively verifiable. It should be auditable. You can't just say it's going to be great and move on. You need to be able to support it. Also, what's been a little, we've seen it with other auditors and our own auditors, reviewing the tax department's calculations, is the mandate of reversing all the deferred tax assets and liabilities into the future to see kind of the timing of those reversals. In the case where you've got lots of DTAs, deferred tax assets, reversing in a shorter period than the DTLs, you could have a source of income in the future from those DTL reversals that could change your overall conclusion. The other thing with TCJA, NOL carryforwards are subject to an 80% limitation in any given year. So when you do the deferred tax rollout, you could find yourself in a position where the deferred tax liabilities are reversing, towards the tail end of it, creating income, and the NOLs can only offset 80% of that income. So even if you're in a net DTA position with a full valuation allowance, you could have a tax that shakes out based on that 20% gap after the NOL usage, and that tax is a current tax that would be required in that year in the future. So something to look out for, even if you're in a full VA and you kind of ignore it and say there's no entry. I think when you do the deferred tax rollout, it may tell you otherwise. Just a couple of things, just jotted down some high points to consider. There's still kind of TCJA considerations for the provision that's still kind of carrying on to, the quarterly calcs and annual calcs with 162M, which is the executive comp, and there's just still a lot of things that kind of are shaken out. CARES Act, Duane mentioned all of the things in the CARE Act that could impact the provision, NOL carrybacks, AMT refunds. 163J, that disallowance is not a permanent item, it's a carry forward, so it's a temp. Looking at debt modifications, which Duane alluded to, if there's a significant debt modification, there could be a gain on the deemed exchange or OID or COD, et cetera. 382, when there's consolidations and there's a lot of transaction activity going on in this industry, you could get to a Section 382 ownership change pretty quickly. So that requires a study. And then if there is a change, you've got to go through all the nuances of the limitations and what that means to your overall net deferred tax position. With the consolidation, you got transaction costs, which generally are non-deductible. So may want to look at really what all those transaction costs entail. There is a safe harbor out there to get some of it, so that's a permanent disallowance, which has a pretty big impact on the provision. ASU 2019-12, which is an accounting standards update, came out this past year. It's really a simplification update to accounting for income taxes, and I won't go through all of the simplification items in it, but one of which is which we run across quite a bit in oil and gas in interim reporting, where your year-to-date quarterly loss is greater than your annual projected loss, meaning the rest of the year looks rosy, but we've had a loss, up to this point. Generally, under that rule, historically, you can't book the benefit from that loss greater than what you think the annual loss benefit would be. So it really scales back your interim loss. In this ASU 2019-12, you don't have to do that anymore. And this update is really effective for public companies 2021, private companies 2022. You can definitely early adopt. So for publics, you can have this in 2020. Just a couple of remaining items. Duane mentioned the PPP loan forgiveness. If the current guidance still stands, and if you're anticipating forgiveness in 2021, all of your expenses in 2020 are non-deductible, which has an impact on your provision. FIN 18, your quarterly, interim reporting, talking about valuation allowances. If you're changing your position on it, whether or not you're changing the beginning of your balance versus changing your position throughout the current year, there's a big difference between having it part of your annual effective tax rate or a discrete item. Just some final considerations, always issues at the state level, especially with all the legislation that's happened. TCJA, some states adopted it, some states didn't. Bonus depreciation, there's a lot of states that don't follow bonus depreciation, so you have to cover it over 7 years, makers. 163J, there's a lot of states that don't follow that, and then the CARES Act as well. So you can't just take all the federal activity, subject it to apportionment, and then multiply it by the statutory rates and say you're done. You really got to look state by state and make sure you've got all the right state adjustments factored in. Amy, we're at our final polling question.
All right, thank you. So our last question is, currently, what is the largest type of tax that oil and gas companies pay? A, sales and use tax, B, severance tax, C, state income tax, or D, property tax. And then I also just wanted to remind you that once you have completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And I'll wait a moment before showing the results here. Okay, here you go.
All right, I'll take over. I'm Marty Tschida, a partner in our principal in our Denver office, focusing on state and local tax. I would say for that poll question, I think that's probably accurate, severance tax, but like any good state and local tax consultant, I think it really depends. Depends on the state you're working in, the operations of your company, commodity pricing, where this year property tax might actually be the highest tax this year. So I'm going to quickly talk about 3 things. State income tax nexus in 2020, something I never thought would be a big issue for oil and gas companies, but it is 2020, so new change there. Also going to talk about property tax and the 1/1/21 valuation to see what opportunities could be for oil and gas companies. And then finally, going to talk about a couple quick severance tax updates as well. So state income tax nexus in 2020, I think the big takeaway here is, what are your employees doing currently? For oil and gas, it was always simple to understand nexus, or that connection between a state tax jurisdiction and the taxpayer, i.e. the obligation for taxpayers to file in that particular state. Where now that we're seeing workers not come into downtown offices and might have more flexibility, are these workers going to other states and working from there? Well, this could cause issues with the company itself to say, hey, if you have an employee that's sitting on a beach now for the last 6 months in California, where you haven't had that before, where they are always coming in to work, do you now have another state filing obligation? And worse, have you opened yourself up to some of California's reporting that has to be done? So this is something that I'm seeing in oil and gas particularly. You know, we've always dealt with this on internet companies or manufacturing companies, but oil and gas, it's new this year with having employees going throughout the country. This could cause Secretary of State registrations, income tax withholding for your employees, also unemployment insurance. You have gotten some guidance from states that would allow a 30, 60-day, 90-day grace period. There is somewhat hope that Congress would pass something, although not a lot of hope that we'll get it this year. Florida, California, both these two states, in fact, I checked the Florida website just the other day. They are pretty adamant that if you're doing business in Florida, that you will need to be filing in one of those having an employee in the state. So things to look out for is really to understand where your employees are working out of and if that changed. Up here on the slide, separate, combined, consolidated, this is just to point out the different kinds of filing that could be done, depending on if you're a C Corp or a pass-through. So something to look at into 2020 is, are you going to be filing in the same states as you did last year and the same type of reporting approach? For property tax, moving on, this 1/1/21 valuation year is probably going to be one of the biggest property tax years, simply because of this first bullet point that people need to ask themselves. Has my property value declined between 1/1/20 and 1/1/21? Maybe my assets aren't as productive if they're not in service, if I'm an oil field service company. Maybe pricing has significantly hurt my operations. I'm not using specific buildings. So there's a lot of different opportunities when we approach 1/1/20 versus 1/1/21 reporting. There is potential for look-back periods in certain jurisdictions, but I think looking into 2021, keeping in mind that filing those renditions in 2021, and then really looking at that review of the notice of valuations to see if there's room for protests, getting that documentation together to reduce that property tax value for your assets. This is both on E&P companies as well when we're dealing with netback calculations for reserves, as well as future cash flow calculations for reserves. I'll leave you with 3 different severance tax items here and updates. Utah recompletion workover credit. Utah's always had this credit, but they recently redid some of the requirements in order to qualify. You now have to have a CPA to review these expenditures, and there are some really tight deadlines with 30-day, 60-day deadlines after this recompletion or workover actually was completed. It is a lucrative credit. Anyone that has done Utah knows that severance tax liabilities are important in operations for Utah, and this provides a $30,000 per year credit, and you can go back 6 years for Utah to file refund claims. Granted, this credit sometimes causes issues about documentation to go back 6 years as well, but $30,000 a year for a credit is very lucrative in Utah. Texas severance tax, with oil and gas prices what they are, we're getting a lot more marginal well benefit for these commodities. Therefore, reviewing that to ensuring that you actually have your wells certified. The second bullet point, a lot of high-cost gas well exemptions that were submitted in the recent years. Those are starting to fall off now. So it's always a good time to go and review your exemptions within Texas to make sure that you're capturing all of that within the within the 4-year statute of limitations. Finally, ending on Colorado, the ad valorem tax credit review. I think it'll be a big deal for the 2021 legislative session. Like many states, they have a budget shortfall of billions of dollars. Therefore, they're trying to make ends meet there. So the ad valorem tax credit, if that goes away, that would definitely make an impact on effective production tax rates for companies. And I think it's something that all companies can look at, especially, particularly on the E&P side, is to look at your production tax rates and your effective to see if there's changes that need to be done or do these need to be looked at further. not only from a book perspective, but also from a cash perspective to make sure that cash doesn't go out the door if it doesn't have to. So that's the state and local update. I'll pass it over to Pat to give some final thoughts.
Thanks, Marty. We're coming up on the hour, and we want to respect everyone's time. So we won't really address any Q&A at this point, but certainly here's the contact information that you can reach out to any one of us if you have any follow-up questions on anything we've discussed. Certainly, we covered a lot of content in a very short period of time, so each one of these topics could probably warrant a separate CPE session. So definitely more questions. If you have them, reach out to us. We'd be gladly there to help you. Some additional resources that we have on our website are out there, and then kind of some final thoughts. There's some more energy webcast series that Moss Adams is providing. So please attend that if your schedules allow. And we want to thank you all for attending. We really appreciate your time. And now I'll pass it back to Amy to close us out.
All right, well, thank you. And thank you, Pat, Duane, and Marty for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important. Thank you for joining us, and we hope you'll join us again next time.
Hey, Byron. Oh, hold on.